Introduction to real estate cycles. Real estate cycles represent the recurring patterns of boom and bust that characterize property markets. These cycles are driven by a complex interplay of economic, demographic, and financial factors, influencing property values, rents, and development activity. Understanding these patterns is crucial for investors seeking to make informed decisions and optimize their portfolios. Unlike general economic cycles, real estate cycles often have their own unique timing and amplitude, requiring specialized analysis. Recognizing the current position within a cycle allows for proactive strategies rather than reactive responses. This foundational knowledge is the cornerstone of successful real estate investment. The study of real estate cycles provides a framework for anticipating market shifts and preparing for future conditions. It helps investors avoid common pitfalls, such as buying at the peak of a boom or selling during a downturn. By identifying the underlying forces at play, one can better predict future supply and demand imbalances. This strategic foresight enables investors to capitalize on opportunities and protect their assets. Ultimately, a deep understanding of these cycles is a powerful tool for maximizing long-term returns in real estate. Phases of the real estate cycle. Real estate cycles are typically divided into 4 distinct phases: recovery, expansion, hypersupply, and recession. Each phase is characterized by specific market conditions, investor sentiment, and development activity. Understanding these phases is fundamental to navigating the market effectively and making timely decisions. The transition between phases is often gradual, but identifying the dominant characteristics helps in strategic planning. These phases do not always occur with equal duration or intensity, varying by market and property type. However, their general sequence provides a reliable roadmap for analysis. The recovery phase begins after a recession, marked by stabilizing prices and increasing occupancy. This leads into the expansion phase, where demand outpaces supply, driving up rents and property values. Following expansion, the hypersupply phase emerges as new construction exceeds demand, leading to rising vacancies. Finally, the recession phase sees declining demand, falling prices, and reduced development. Recognizing which phase a market is in allows investors to tailor their strategies, whether it's acquiring assets, developing new projects, or divesting properties. Each phase presents unique opportunities and challenges for real estate professionals. Recovery phase characteristics. The recovery phase marks the beginning of an upward trend after a market downturn. During this period, vacancy rates start to stabilize or slightly decrease as demand slowly picks up. Rents remain relatively flat or show very modest increases, as landlords are still cautious about pushing prices too high. New construction activity is minimal, often limited to projects that were already underway, or those with strong pre-leasing commitments. Investor sentiment is typically cautious but gradually improving, with smart money beginning to re-enter the market. Property values are at their lowest or have just begun to appreciate, offering attractive entry points for long-term investors. This phase is characterized by a gradual return of confidence and economic activity. Key indicators of a recovery phase include declining unemployment rates and an increase in consumer spending. Business expansion starts to occur, leading to greater demand for commercial and industrial spaces. Transaction volumes may still be low, but are showing signs of improvement compared to the recession. Capitalization rates are generally high, reflecting lower property values and higher potential yields. This phase is often the most opportune time for patient investors to acquire assets at favorable prices before widespread competition drives values up. Identifying the early signs of recovery requires careful analysis of local economic data and market fundamentals. Expansion phase dynamics. The expansion phase is characterized by robust growth across the real estate market. Demand for properties, both residential and commercial, significantly increases, often outstripping available supply. This strong demand drives up rental rates and property values at an accelerated pace. New construction projects become prevalent, with developers actively acquiring land and breaking ground on numerous ventures. Investor confidence is high, leading to increased transaction volumes and competitive bidding for desirable assets. Capitalization rates begin to compress as property values rise faster than net operating income. This period is marked by widespread optimism and a sense of prosperity. During expansion, employment growth is strong and consumer confidence is high, fueling further demand for housing and retail spaces. Businesses are expanding, requiring more office and industrial properties. Lending standards may become more relaxed, making it easier for buyers and developers to secure financing. Speculative activity can also increase as investors chase rising prices. While profitable, this phase requires careful monitoring to avoid overpaying for assets or getting caught in unsustainable development. Recognizing the peak of this phase is critical to preparing for the subsequent market shift. Hypersupply phase indicators. The hypersupply phase emerges when new construction, driven by previous expansion, begins to exceed actual market demand. This overbuilding leads to a noticeable increase in vacancy rates across various property types. Rental growth starts to slow significantly, and in some cases, rents may even begin to decline as landlords compete for tenants. Property values, while still potentially high, experience decelerated appreciation or plateau. Developer confidence wanes, and new project starts become less frequent as market saturation becomes evident. This phase signals a shift from a seller's market to a buyer's or balanced market. Key indicators of hypersupply include a rising inventory of unsold homes or vacant commercial spaces. Absorption rates, which measure how quickly available properties are leased or sold, begin to decline. Concessions from landlords, such as free rent periods or tenant improvement allowances, become more common to attract and retain occupants. Lending institutions may tighten their underwriting standards, making it harder to secure financing for new developments. Investors need to exercise extreme caution during this phase, focusing on tenant retention and avoiding speculative purchases. Recognizing these signs early allows for strategic adjustments to investment portfolios. Recession phase realities. The recession phase represents the downturn of the real estate cycle, often coinciding with broader economic contractions. During this period, demand for properties significantly declines, leading to a sharp increase in vacancy rates. Rental rates fall, and landlords may offer substantial concessions to retain tenants or fill empty spaces. Property values experience significant depreciation, and distressed sales become more common as owners face financial difficulties. New construction virtually halts, and many projects are postponed or cancelled. Investor sentiment is generally negative, characterized by fear and uncertainty, leading to reduced transaction volumes. Key indicators of a real estate recession include rising unemployment, declining consumer confidence, and a tightening of credit markets. Foreclosures and bankruptcies increase, adding more supply to an already saturated market. Capitalization rates typically rise as property values fall, but investors are hesitant to enter due to perceived risks. This phase can be challenging for existing property owners and developers, but it also presents unique opportunities for well-capitalized, counter-cyclical investors. Acquiring assets at deeply discounted prices during a recession can lead to substantial returns in subsequent recovery phases. strategic patience and strong financial reserves are paramount during this period. Economic drivers of cycles. Real estate cycles are profoundly influenced by broader macroeconomic factors. Gross domestic product, GDP growth, representing the total economic output, directly impacts demand for all types of property. A strong GDP typically correlates with increased employment, higher incomes, and greater business expansion, all of which fuel real estate activity. Conversely, a contracting GDP often signals a downturn in the property market. Employment levels are a critical driver. When more people are employed, there is greater demand for housing and commercial space. Wage growth also contributes to affordability and purchasing power, further stimulating the market. These fundamental economic indicators provide a strong foundation for understanding cyclical movements. Inflation and deflation also play significant roles in shaping real estate cycles. Moderate inflation can be beneficial, as property values and rents tend to keep pace or even outstrip rising costs. However, high inflation can lead to increased interest rates and reduced affordability, dampening demand. Deflation, on the other hand, can lead to falling asset values and economic stagnation. Consumer confidence, while often a lagging indicator, reflects the general public's optimism about the economy and their willingness to make large purchases, including homes. Monitoring these economic drivers is essential for predicting shifts in the real estate market and adjusting investment strategies accordingly. Demographic influences on real estate. Demographic trends are powerful, long-term drivers of real estate cycles, influencing both demand and property types. Population growth, particularly in urban centers, creates a fundamental need for more housing and supporting infrastructure. Migration patterns, both internal and international, can significantly impact specific regional markets, leading to booms in some areas and stagnation in others. The formation of new households, driven by factors like marriage rates and young adults leaving home, directly translates into demand for residential units. These shifts are often slower moving than economic cycles, but have a profound and lasting effect on real estate markets. Age distribution within a population also plays a crucial role. A growing youth demographic often fuels demand for starter homes and rental properties, while an aging population may drive demand for senior living facilities and smaller, more accessible housing. Lifestyle preferences, such as the desire for urban living versus suburban homes, also shape development trends. Understanding these demographic shifts allows investors to anticipate future demand for specific property types and locations. Ignoring these underlying population dynamics can lead to misjudged investments, making demographic analysis a cornerstone of long-term real estate strategy. Government policy and regulation. Government policies and regulations exert significant influence over real estate cycles. Monetary policy, set by central banks, directly impacts interest rates, which in turn affect borrowing costs for mortgages and development loans. Lower interest rates typically stimulate demand and construction, while higher rates can cool the market. Fiscal policies, including taxation and government spending, also play a role. Property taxes, capital gains taxes, and incentives for affordable housing can all shape investment decisions and market activity. These policy decisions can either accelerate or decelerate cyclical movements, making them crucial factors to monitor. Zoning laws and building regulations are powerful local government tools that control land use and development density. Restrictive zoning can limit supply, potentially driving up prices, while more permissive policies can encourage new construction. Environmental regulations and permitting processes can also add significant time and cost to development projects, influencing supply pipelines. Government infrastructure spending, such as new roads or public transit, can unlock development potential in previously underserved areas, creating new market opportunities. Understanding the regulatory landscape is essential for predicting future supply and demand dynamics and assessing investment feasibility. Supply and demand fundamentals. The fundamental principles of supply and demand are at the heart of real estate cycles. When demand for property exceeds the available supply, prices and rents tend to rise, signaling an expansionary phase. Conversely, when supply outstrips demand, prices and rents typically fall, leading to a hypersupply or recessionary environment. Real estate supply is inherently inelastic in the short term due to the time required for construction and development. This inelasticity means that market imbalances can persist for extended periods, contributing to the cyclical nature of the industry. Understanding this dynamic is crucial for anticipating market shifts. Demand for real estate is influenced by a multitude of factors, including population growth, employment rates, income levels, and interest rates. Supply, on the other hand, is primarily driven by new construction, conversions, and the availability of developable land. The interaction between these forces creates the upward and downward pressures observed in property markets. Analyzing metrics like vacancy rates, absorption rates, and construction pipelines provides insights into the current balance of supply and demand. A thorough understanding of these fundamentals allows investors to identify undervalued opportunities or recognize when a market is becoming oversupplied, guiding their investment decisions. Interest rate impact on real estate. Interest rates are a primary determinant of real estate market activity and a significant driver of cycles. Lower interest rates reduce the cost of borrowing for mortgages and development loans, making property more affordable for buyers and projects more feasible for developers. This typically stimulates demand, increases purchasing power, and encourages new construction, contributing to an expansionary phase. Conversely, higher interest rates increase borrowing costs, reducing affordability and dampening investor appetite. This can lead to decreased demand, slower sales, and a contraction in development, pushing the market towards hypersupply or recession. The Federal Reserve's monetary policy decisions are closely watched by real estate professionals for these reasons. The impact of interest rates extends beyond just affordability. It also affects investor returns and property valuations. When interest rates are low, the discount rate used to value future cash flows from properties is lower, potentially increasing present values. This can make real estate investments more attractive compared to other asset classes. However, rising interest rates can make alternative investments more appealing, drawing capital away from real estate. Furthermore, higher rates can increase the cost of refinancing existing debt, potentially creating financial strain for property owners. Understanding the relationship between interest rates and real estate is crucial for timing investments and managing financial risk effectively throughout the cycle. Credit availability in real estate. The availability of credit is a critical factor that can significantly amplify or dampen real estate cycles. When credit is readily available and lending standards are relaxed, it becomes easier for individuals to obtain mortgages and for developers to secure construction loans. This increased access to capital fuels demand, encourages new development, and can accelerate price appreciation during an expansionary phase. Easy credit can also lead to speculative buying and overbuilding, contributing to the eventual hypersupply. The flow of capital into the real estate market is a powerful force, shaping its trajectory. Conversely, a tightening of credit availability, often seen during economic downturns, can severely restrict real estate activity. When banks become more cautious, increasing down payment requirements, raising interest rates, or reducing loan-to-value ratios, it becomes harder for buyers and developers to secure financing. This reduction in capital can quickly cool a hot market, leading to decreased transaction volumes, falling prices, and a halt in new construction. The credit crunch of 2008 is a stark example of how restricted credit can trigger and deepen a real estate recession. Monitoring lending standards and capital flows is therefore essential for understanding and predicting cycle movements. Analyzing market data. Effective real estate cycle analysis relies heavily on interpreting key market data. Vacancy rates, which measure the percentage of unoccupied units, are a crucial indicator of supply and demand balance. Rising vacancy rates typically signal an oversupplied market, while falling rates suggest increasing demand. Absorption rates, representing the pace at which available properties are leased or sold, provide insight into market velocity. A high absorption rate indicates strong demand, whereas a low rate points to a sluggish market. These metrics offer a snapshot of current market health and help forecast future trends. Rent growth and property value appreciation are also vital data points for understanding market momentum. Consistent rent increases signal a healthy, expanding market, while stagnant or declining rents indicate a slowdown. Tracking sales volumes and average transaction prices provides further evidence of market activity and investor sentiment. Construction pipeline data, including permits issued and projects under development, helps assess future supply. By systematically collecting and analyzing these various data points, investors can gain a comprehensive understanding of where a market stands within its cycle and make more informed investment decisions. This data-driven approach minimizes speculation and enhances strategic accuracy. Forecasting future trends. Forecasting future real estate trends is a challenging but essential component of maximizing returns. It involves synthesizing various data points, including economic indicators, demographic shifts, and policy changes, to project future market conditions. While no forecast is perfectly accurate, employing robust analytical models can significantly improve predictive capabilities. Quantitative methods, such as regression analysis and time series forecasting, can identify correlations and extrapolate historical patterns into the future. These models help to estimate future demand, supply, and price movements, providing a basis for strategic planning. However, it is important to remember that unforeseen events can always alter market trajectories. Qualitative analysis also plays a crucial role in forecasting, incorporating expert opinions, market sentiment, and local insights that quantitative data might miss. Understanding geopolitical events, technological advancements, and evolving consumer preferences can provide valuable context for projections. Scenario planning, where different potential futures are modeled based on varying assumptions, helps investors prepare for a range of outcomes. Combining both quantitative and qualitative approaches offers a more holistic and resilient forecasting framework. The goal is not to predict the exact future, but rather to understand the probabilities of different scenarios and position investments accordingly, minimizing risk and maximizing potential upside. Identifying cycle turning points. Identifying cycle turning points is perhaps the most critical skill for maximizing real estate returns. These points, where a market shifts from one phase to another, offer the greatest opportunities for strategic action. Early indicators of a recovery include stabilizing vacancy rates, a slowdown in distressed sales, and a gradual increase in transaction volumes. For an expansion, look for accelerating rent growth, declining cap rates, and a surge in new construction permits. Recognizing these shifts requires diligent monitoring of a wide array of market data and economic indicators. It is a nuanced process that combines quantitative analysis with qualitative observation. The transition from expansion to hypersupply is often signaled by a significant increase in construction completions, coupled with rising vacancy rates and decelerating rent growth. A recessionary turning point is typically marked by a sharp increase in unemployment, a tightening of credit, and a rapid decline in property values and transaction volumes. While no single indicator provides a definitive signal, a confluence of several warning signs should prompt investors to adjust their strategies. Being early to recognize a turning point can mean the difference between significant gains and substantial losses. This proactive approach is key to navigating the inherent volatility of real estate markets. Investment strategies. Recovery. During the recovery phase, investment strategies focus on acquiring undervalued assets with strong long-term potential. This period, often characterized by low prices and reduced competition, presents an excellent opportunity for patient capital. Investors should target properties that were distressed or underperforming during the recession but are fundamentally sound. Value-add strategies, such as renovating outdated properties or improving management, can unlock significant equity as the market improves. Due diligence is paramount to ensure the underlying asset quality and location are strong, even if current cash flow is modest. The goal is to position oneself for substantial appreciation as the market transitions to expansion. Key tactics in the recovery phase include seeking out motivated sellers, often those facing financial pressure or needing to divest non-core assets. Focusing on markets with strong underlying economic fundamentals and positive demographic trends is crucial, as these areas are likely to recover first and most robustly. Securing favorable financing terms can also enhance returns, as lenders may be more conservative but still willing to lend on solid assets. Long-term hold strategies are often most effective here, allowing time for market appreciation and rent growth to materialize. This phase rewards those who can identify intrinsic value and have the patience to wait for the market to rebound. Investment strategies. Expansion. During the expansion phase, investment strategies shift from opportunistic acquisition to maximizing growth and optimizing existing assets. This period is characterized by rising rents, increasing property values, and high demand. Development projects become highly profitable, and investors may focus on new construction in prime locations or expanding existing portfolios. Value-add strategies continue to be effective, but with a focus on capturing higher rents through premium finishes or amenities. The goal is to capitalize on the strong market momentum and generate significant cash flow and appreciation. However, it's crucial to avoid overpaying for assets as competition intensifies. Key tactics in the expansion phase include selective development in high-growth submarkets, focusing on property types with strong demand drivers. Aggressive rent management and tenant retention strategies are vital to maximize income. Investors may also consider refinancing existing properties to pull out equity for further investment or to lock in favorable interest rates. While the market is strong, it is important to maintain disciplined underwriting and avoid speculative ventures that rely solely on continued price appreciation. Preparing for the eventual market shift by monitoring key indicators and having clear exit strategies in mind is also a prudent approach during this prosperous time. Investment strategies. Hypersupply. In the hypersupply phase, investment strategies shift towards caution, preservation of capital, and selective opportunities. New construction has outpaced demand, leading to rising vacancy rates and slowing rent growth. Investors should avoid speculative development and instead focus on stabilizing existing assets. Tenant retention becomes paramount, requiring proactive management and potentially offering concessions to prevent vacancies. Acquiring properties during this phase requires extreme selectivity, targeting assets with strong fundamentals that are priced below replacement cost or offer significant value-add potential. The market is transitioning, and a defensive posture is often the most prudent approach. Key tactics include rigorous due diligence on any potential acquisitions, focusing on properties with stable cash flows and resilient tenant bases, renegotiating leases with existing tenants, and exploring creative marketing strategies to attract new ones are essential. Investors may also consider divesting weaker-performing assets or those in submarkets showing significant oversupply. Maintaining strong liquidity is crucial to weather potential downturns and capitalize on distressed opportunities that may arise in the subsequent recession. This phase demands a disciplined approach, prioritizing risk mitigation over aggressive growth and preparing for the next market correction. Investment strategies. Recession. The recession phase, while challenging, presents unique and often highly lucrative opportunities for well-capitalized investors. Strategies during this period focus on acquiring distressed assets at deeply discounted prices. This includes properties from foreclosures, bankruptcies, or motivated sellers facing financial pressure. Counter-cyclical investing, buying when others are selling, can yield significant long-term returns. Rigorous due diligence is essential to identify truly undervalued assets with strong underlying fundamentals, rather than simply cheap properties with inherent flaws. The goal is to acquire quality assets at the bottom of the market, positioning for substantial appreciation in the subsequent recovery. Key tactics involve maintaining strong liquidity to act quickly when opportunities arise. Developing relationships with lenders, brokers, and distressed asset specialists can provide access to off-market deals. Investors may also explore niche strategies such as loan acquisitions or investing in real estate debt. Patience is crucial, as the market may take time to bottom out and recover. However, the rewards for those who can navigate this phase successfully can be substantial, as assets acquired during a recession often generate the highest returns over the full cycle. This period demands courage, financial strength, and a clear understanding of long-term value. Risk management across cycles. Effective risk management is paramount for navigating the inherent volatility of real estate cycles and maximizing returns. During expansion, the risk of overpaying for assets or engaging in speculative development increases. In hypersupply, the primary risks are rising vacancies and declining rents. Recession brings risks of falling property values, financial distress, and illiquidity. A robust risk management framework involves identifying potential threats, assessing their likelihood and impact, and developing strategies to mitigate them. This proactive approach helps protect capital and ensures long-term portfolio resilience. Key risk mitigation strategies include maintaining appropriate leverage levels, avoiding excessive debt that could become unsustainable during a downturn, diversification across property types, geographies, and investment strategies helps spread risk and reduce exposure to any single market segment. Implementing conservative underwriting standards, even during boom times, ensures that investments are fundamentally sound. Stress testing portfolios against various economic scenarios, such as interest rate hikes or prolonged recessions, prepares investors for adverse conditions. Having strong cash reserves provides liquidity to weather downturns and capitalize on opportunities. Continuous monitoring of market indicators and adapting strategies accordingly are essential for effective risk management throughout all phases of the real estate cycle. Diversification in real estate. Diversification is a fundamental principle of risk management in real estate, crucial for navigating cyclical fluctuations. It involves spreading investments across different property types, such as residential, commercial, industrial, and retail. Each property type may perform differently in various phases of the cycle, providing a hedge against downturns in a single sector. For example, industrial properties might remain strong during a period when retail is struggling. Diversifying reduces the overall risk exposure of a portfolio and can lead to more stable, consistent returns over time. It prevents over-reliance on any one segment of the market. Geographic diversification is equally important, spreading investments across different cities, regions, or even countries. Local real estate markets often operate on their own microcycles, influenced by specific economic and demographic factors. A downturn in one city might be offset by growth in another, mitigating overall portfolio risk. Furthermore, diversifying by investment strategy, e.g., core, value-add, opportunistic, and by holding period can further enhance resilience. A well-diversified real estate portfolio is better positioned to withstand market shocks and capitalize on opportunities that arise in different segments or locations throughout the real estate cycle. This strategic approach is key to long-term success. Leverage and debt management. Leverage, the use of borrowed capital to finance an investment, can significantly amplify returns in real estate, but also magnify risks. During expansionary phases, when property values are rising, strategic use of debt can boost equity returns. However, excessive leverage can become a major liability during downturns, leading to financial distress or foreclosure if property values decline and cash flows are insufficient to cover debt service. Effective debt management involves understanding the optimal debt-to-equity ratios for different property types and market conditions. It's a delicate balance between enhancing returns and maintaining financial stability. Managing debt effectively across real estate cycles requires careful planning and flexibility. During periods of low interest rates, refinancing existing loans to secure more favorable terms or extend maturities can improve cash flow and reduce interest rate risk. However, during rising interest rate environments, fixed-rate debt can provide stability, protecting against increased borrowing costs. Maintaining strong relationships with lenders and having access to diverse financing options are also crucial. Investors should stress test their debt structures against various market scenarios to ensure they can withstand potential downturns. Prudent debt management is a cornerstone of long-term real estate success, ensuring that leverage remains a tool for growth rather than a source of vulnerability. Exit strategies and timing. Developing clear exit strategies and understanding optimal timing are critical for maximizing returns in real estate. An exit strategy defines how an investor plans to dispose of a property, whether through sale, refinancing, or holding long-term. The timing of this exit is heavily influenced by the real estate cycle. Selling at the peak of an expansionary phase when demand and prices are highest can lock in significant profits. Conversely, being forced to sell during a recession can lead to substantial losses. Therefore, planning the exit before acquisition is a fundamental principle of strategic investing. Key considerations for timing an exit include monitoring market indicators like rent growth, vacancy rates, and new construction pipelines. A slowdown in rent growth, combined with rising vacancies, might signal that the market is nearing hypersupply, suggesting it's time to consider selling. Conversely, strong market fundamentals and continued appreciation indicate a favorable selling environment. Having multiple exit options provides flexibility. For example, if market conditions are not ideal for a sale, refinancing to extract equity and holding for a longer term might be a viable alternative. Strategic timing, informed by cycle analysis, ensures that investors capture the maximum value from their assets and avoid being caught in a market downturn. Case studies. Past cycles. Examining historical real estate cycles provides invaluable lessons for understanding current and future market dynamics. Analyzing past booms and busts, such as the dot-com bubble burst in the early 2000s or the 2008 financial crisis, reveals recurring patterns and common triggers. These case studies highlight how economic shifts, credit availability, and investor sentiment have historically influenced property markets. By studying these events, investors can identify leading indicators, understand the typical duration and amplitude of different phases, and learn from both successful and unsuccessful strategies employed during those times. History, while not perfectly repeatable, often rhymes in real estate. Each historical cycle offers unique insights into the interplay of various market forces. For instance, the 2008 crisis underscored the dangers of subprime lending and excessive leverage, while earlier cycles might emphasize the impact of interest rate hikes or overbuilding. Understanding the specific context of these past events helps to contextualize current market conditions and avoid making similar mistakes. These case studies are not just historical anecdotes, they are practical lessons in risk management, strategic timing, and the importance of fundamental analysis. Integrating these historical perspectives into current decision-making enhances an investor's ability to navigate future cycles with greater confidence and foresight. Global versus local cycles. Real estate markets are influenced by both global macroeconomic forces and highly specific local dynamics. Global factors such as international capital flows, commodity prices, and major geopolitical events can create overarching trends that affect multiple national markets. For instance, a global economic recession will likely impact real estate demand worldwide. However, these global influences often manifest differently at the local level. Understanding this interplay is crucial, as a broad global trend might not accurately reflect the conditions in a specific city or neighborhood. Local market conditions are often more nuanced and responsive to immediate factors. Local real estate cycles are driven by factors unique to a specific geographic area, including local employment growth, industry diversification, population migration within a country, and local government policies. A city with a booming tech industry, for example, might experience strong real estate growth even during a national slowdown. Conversely, a region heavily reliant on a single declining industry could face a downturn despite a robust national economy. Investors must conduct thorough local market analysis, focusing on microeconomic indicators and specific supply-demand dynamics. Relying solely on global or national trends can lead to misinformed decisions, underscoring the importance of a granular bottom-up approach to real estate cycle analysis. Long-term wealth building. Integrating knowledge of real estate cycles into a long-term wealth building strategy is essential for sustainable success. This involves adopting a patient, disciplined approach that prioritizes fundamental value over short-term speculation. By understanding the cyclical nature of the market, investors can make counter-cyclical moves, acquiring assets during downturns and optimizing them during expansions. The goal is to accumulate a portfolio of high-quality, income-producing properties that appreciate over time, generating consistent cash flow and building substantial equity. This strategic foresight allows investors to ride out market fluctuations and emerge stronger. A long-term perspective also emphasizes the power of compounding returns and the benefits of holding assets through multiple cycles. While short-term gains can be attractive, true wealth in real estate is often built over decades. This requires a focus on strong property management, tenant retention, and continuous value enhancement. Regularly reviewing and adjusting the portfolio based on evolving market conditions and personal financial goals is also crucial. By consistently applying cycle-informed strategies, investors can mitigate risks, capitalize on opportunities, and achieve significant financial independence through real estate. This diploma provides the framework for such a robust and enduring investment journey.